Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of how sequence of returns risk can impact your retirement. Understanding sequence of returns risk in retirement planning. Have you ever thought about how the timing of returns can impact your retirement nest egg? Sequence of returns risk is a concept that can make or break your financial plans if you're not careful. It's not just about how much you save or the average return rate. It's also about when you get those returns. This risk doesn't get enough attention, yet it's crucial for anyone thinking about retirement. Understanding it can help you avoid running out of funds too soon. We'll break down why this risk matters and what you can do to safeguard your wealth for the golden years. Defining sequence of returns risk. Imagine stepping into the world of retirement, ready to enjoy the fruits of years of hard work. But there's a twist, a hidden player in the retirement game called sequence of returns risk. This concept revolves around how the order of your investment returns can greatly affect your financial security once you stop working. It's not just about how much your investments grow, but also when those fluctuations occur. Let's explore its importance and influence on retirees. The importance of the sequence of returns. The sequence of returns is like the order of events in a carefully plotted novel. The same elements can lead to vastly different outcomes depending on how they unfold. For retirees, this sequence plays a crucial role because they depend on withdrawing from their savings. Volatile returns. Suppose you start withdrawing funds in a market downturn. Even if long-term returns look rosy, that initial hit can severely dent your savings. Early losses can mean selling more assets at low prices, leaving less to rebound when markets recover. Retirement timing. Consider 2 retirees with identical portfolios. One faces a market slump right after retirement, while the other enjoys a boom. Over time, these market movements can change the nest egg dramatically. The first retiree might run out of funds sooner despite similar investment strategies. Why is this particularly important for retirees? When you're adding to your investment, downturns are opportunities to buy at lower prices. But in retirement, you're often doing the opposite, selling assets for income. A few bad years early in retirement can be far more damaging than the same losses later on. Understanding the unpredictability of the sequence of returns helps us grasp why timing can be as critical as the overall return rates. Planning with this in mind can make a significant difference. Have you considered how retirement timing aligns with market cycles? Recognizing these risks lets you build a more resilient retirement plan. Historical context and evidence. Understanding the intricacies of sequence of returns risk isn't just about theory, it's rooted in real-world events and examples. By looking at past market events and investor experiences, we can see how the order of returns impacts retirement outcomes. Market volatility examples. History offers several stark lessons on how market volatility can wreak havoc on retirement savings. Let's consider the 2008 financial crisis. Investors who retired just before this downturn saw their portfolios take a significant hit. For instance, a portfolio with $1 million might have lost 30% in value, forcing retirees to withdraw more from diminished savings. This is in stark contrast to those who experienced the dot-com boom during their early retirement years, witnessing substantial initial growth. The early 2000s provide another example. The dot-com crash followed by a quick recovery showed how markets can swiftly change. If retirees had to sell more stocks when prices plummeted, their financial stability was compromised for years. This sequence of returns, characterized by early losses, underlines the volatility's impact. Such historical moments demonstrate that it's not merely the average return that matters, but the timing of these returns that determines financial security. Comparative case studies. To make sequence of returns risk concrete, let's look at 2 hypothetical retirees, Alice and Bob. Both start with $1 million and withdraw $50,000 annually. Alice retires during a bull market. Her portfolio grows early on, and even if later years deliver lower returns, her nest egg remains healthy. The positive sequence of returns boosts her confidence and financial independence. Bob retires just as a bear market begins. His initial withdrawals, coupled with declining asset values, shrink his portfolio significantly. Even if markets recover later, his savings don't have the same chance to rebound due to early large withdrawals. These scenarios illustrate how two investors, despite identical withdrawal rates and timeframes, can end up with vastly different financial outcomes simply due to the sequence of their investment returns. By learning from the past and studying real-life examples, investors can better prepare for their own retirement journey, understanding that when it comes to market returns, timing is everything. Factors influencing sequence of returns risk. Sequence of returns risk can be a silent disruptor to your retirement plans. It's not just about where you park your money, but also how you manage it throughout retirement. By understanding various factors, you can navigate this risk wisely. Below, we explore a couple of critical components: withdrawal strategies and asset allocation considerations. Withdrawal strategies. Let's talk withdrawal strategies. How you decide to draw down your retirement savings can either shield you from or expose you to sequence of returns risk. Here are a few strategies to consider. Fixed withdrawal rate. This is where you withdraw a set percentage of your portfolio annually, say 4%. It's simple, but if markets drop early, this approach can be risky. Your withdrawals won't adjust to market conditions, potentially depleting your funds quicker during downturns. Dynamic withdrawal. Think of this as a more flexible approach. You adjust your withdrawal rate based on portfolio performance. If your investments are doing well, you might withdraw more. If not, reduce it. This can help protect your nest egg during tough times. The bucket strategy. Picture your savings in 3 buckets: short-term, medium-term, and long-term. Each bucket has assets meant for a different time frame and risk level. This method ensures that during market dips, you're not selling long-term investments, preserving the growth potential of your portfolio. Each strategy has its pros and cons. A fixed rate offers stability, but can be dangerous in volatile markets. Dynamic and bucket strategies provide more flexibility, potentially increasing your portfolio's longevity. Asset allocation considerations. The way you allocate your investments can greatly impact your susceptibility to sequence of returns risk. A balanced portfolio can act like a fortress, reducing the chance of early downturns harming your retirement funds. Here's what to keep in mind. Diversification. Spread out your investments across various asset classes. Stocks, bonds, and other securities react differently to market changes. If stocks take a hit, having bonds can cushion the blow. Risk tolerance. Understand your comfort level with investment risks. A portfolio that's too aggressive can amplify losses when markets are unfavorable, especially early in retirement. Conversely, being overly cautious may limit growth, impacting long-term success. Rebalancing. Regularly adjusting your asset allocation to maintain a desired risk level is crucial. As you withdraw funds or market values shift, rebalancing can help you stay on track and avoid overexposure to volatile assets. Remember, asset allocation isn't a one-time decision. It's a continuous process that requires attention to market dynamics and personal financial needs. By keeping a pulse on your allocation, you're better equipped to manage sequence of returns risk effectively. Mitigating sequence of returns risk. When planning for retirement, one of the trickiest hurdles to tackle is sequence of returns risk. It's that pesky issue of timing. Even with a healthy portfolio, poor timing on returns can eat away at your savings faster than you might imagine. But fear not, there are strategies you can employ to sidestep these risks and keep your retirement plans on track. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.